What's going on, everybody? What's going on? Appreciate everybody for tapping in again. We're back at it again. The stock market was open today. Great day for the market to be open. Thank you. Appreciate, like I said, as always, I thank everybody for tapping in again to another episode. As always, bear with me here for a second. Bear with me here for a second. Thank you for everybody who's in the live chat. I appreciate you. But yeah, y'all, let's not belabor the time anymore. Welcome back again to another episode of the Trade for Yourself podcast, where my mission here is still very, very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure you please like this, okay? Please like this, please. This will really help me with the channel. Please subscribe. Make sure you have that notification bell set so every time I drop a shorts video, which I've been dropping more of those here lately. Okay, every time I drop a shorts video or any video that I drop, you can have it. You can have it right there at your fingertips on your cell phone, and you can be able to view it at any given time. And so today, we want to talk about the stock market and understand what's going on. And, most of the time, we always look at everything from the lens of the S&P 500. And whenever I'm breaking down charts and looking at charts, we're typically looking at ticker symbol SPY a lot. But what I want to do is I want to introduce the ticker symbol QQQ. I want to introduce QQQ because I really truly believe that QQQ can provide us a lot of long-term opportunities in the stock market. And it's something that we need to look into. And so we're going to look at the QQQ ETF, look at the holdings, look at the chart, look at where we are technically, and look at some things that could give us an advantage and could help us do some extra things in our portfolio. So let's go ahead and get started here. Let's go ahead and get started. And so, like I said, we're going to start here looking at QQQ. Now, QQQ is the Invesco QQQ Trust. That's the ETF it is. And so when we talk about SPY is the most traded ETF in the stock market, and QQQ might be the second largest. I'm not 100% sure. But if you look at this is the QQQ website, invesco.com/QQQ-ETF and all that. Invesco QQQ is an exchange-traded ETF fund, is an exchange-traded fund that tracks the Nasdaq 100 index and features Apple, Google, Microsoft, and more. So, SPY is an ETF that tracks the S&P 500, and QQQ is an ETF that tracks the Nasdaq 100. So the largest 100 companies in the Nasdaq. As of right now, there's about 102 holdings in QQQ. There's a little bit of discrepancy there, but let's just look at the top 10 holdings of QQQ. And when we look at the top 10 holdings of QQQ, understand that QQQ delivers exposure to companies that are at the forefront of transformative long-term things, such as augmented reality, cloud computing, big data, mobile payment, streaming services, electric vehicles, and more. And so when we look at QQQ and we look at the NASDAQ is the tech-heavy index, right? It's the index that is mostly technology, okay? And so when we look at these top 10 holdings, we've got Apple coming in at number one, 13.56% of the ETF, Microsoft, 10% of the ETFs. So that's 23% of the ETF, just those two. 6.94% for Amazon coming in number 3. 4, we've got Tesla with 4%. Google Class C shares, 3.67%. Google Class A, 3.54% in terms of the allocation. Now, remember the differences between these classes of shares. Google, Alphabet Class A, those shares will give you voting rights. Okay, the Alphabet Class C shares, those shares do not give you voting rights. Okay, those are the two differences between those two classes of shares. Number 7, we've got Meta Platforms. 8, Nvidia. 9, PepsiCo. And 10, we have Costco. Okay, those are your 10 holdings. Now, if we look at the sector allocations, how is QQQ broken out in terms of allocation? Like we talked about before, information technology is 48.75% of the ETF. Consumer discretionary is 16.4% of the ETF, and communication services is 15.99% of the ETF. So almost 16%, right? So if you look at information technology, consumer discretionary, and communication services, I'm going to quickly add these up here. These three by themselves, these three sectors make up 81% of the ETF. So you are a heavy technology. Now, understand what companies that we're looking at when we talk about these companies, because consumer discretionary, you're really talking about Amazon and Tesla, because Amazon and Tesla are classified as consumer discretionary companies, but they're really tech companies. You know what I'm saying? Google, Facebook, Netflix, right? Those three large cap companies, they are communication services companies based on their classification, but they're really technology companies, right? And so that's what we're looking at in terms of sector allocations. Every single other sector allocation is less than 7%. Healthcare, less than 7%. Consumer staples right behind, less than 7%. Industrials, 3.58%. Utilities, 1.42%. And then not classified as the other ones. Now, I'm just going to quickly go through some of the top companies that we see in these ETFs. So when we talk about information technology, Apple, Microsoft, NVIDIA, Broadcom, Cisco Systems, Texas Instruments, Adobe, Qualcomm. I see Advanced Micro Devices, AMD, company I like a lot, Palo Alto Networks, cybersecurity, Lam Research. We've got Zscaler, we've got Datadog, we've got CrowdStrike, Marvell, ASML, NXP, Fortinet. So we've got some good technology companies here, right? That's what you look at in your information technology. Consumer discretionary, you got Amazon, Tesla, Starbucks, Booking Holdings, right? We got Booking Holdings, we've got Marriott, Airbnb, Mercado Libre, a very good Latin American company, Lululemon. That's what you've got here in consumer discretionary. And I'm gonna go through communication services, and that's all I'm gonna go through in terms of holdings, right? You've got both shares of Google classes, you've got Meta, you've got T-Mobile, you've got Netflix, Activision Blizzard, which we believe will be required by Microsoft, right? Let's keep our fingers crossed. Okay, let's keep our fingers crossed. We've got Baidu, and Baidu, I believe, is a Chinese company, right? A Chinese company. Charter Communications. So you got some interesting companies here, right? And so when we look at QQQ, let's go back to these top 10 holdings again, right? And so me personally, I talk a lot about the S&P 500 because you get broad diversification from all sectors, right? But QQQ, like, you're really, really concentrated in tech. Like that's where you at. That's where you're at, and that's where you want to be. And I don't blame you. I think you being right here in that line of technology is really where you want to be in terms of providing great opportunities in the long term. And so since we got these top 10 holdings in QQQ, let's just, for the sake of argument, compare the top 10 holdings in SPY, right? The top 10 holdings in SPY are going to be pretty similar. They're going to be pretty similar. Apple is 6.96%, almost 7%. Microsoft, 5.5%. Amazon, 3.3%. Alphabet Class A is 1.93%. Tesla's 1.91% here. Google Class C, that's 1.74%. So Tesla's right in between those two classes of Google shares. You've got Berkshire Hathaway Class B, United Health, Johnson & Johnson, and Exxon Mobil. And so Exxon Mobil has came up and become a bigger portion of the S&P 500, which really kind of makes sense, because energy has been the best performing sector in the market this year, and NVIDIA has been getting beat to sleep. So NVIDIA was at one point in the top 10, but now they are no longer in the top 10 because of the beating that the stock has taken. Okay. And so when we look at the S&P 500, you're getting broad diversification. You're heavy technology. Don't get me wrong. You're heavy technology, but but you've also got you also got your holding companies. You've got healthcare, right? You've got energy. You've got materials, industrials. Everything is more spread out. Everything is really more spread out. Even when you look at the sector allocation here, you look at the sector allocation, 25.92% is information technology. So QQQ, you've got double the amount of technology over in QQQ, right? Healthcare is 15.27%. Consumer discretionary is 11%. Financials is almost 11%. Industrials is 8%. Communication services is 8%. Consumer staples is 6.92%. Energy is 5.13%. Utilities is 3%. Real estate 2.67%. Materials 2.55%. And so you have every single sector that is recognized in the entire stock market when the same is not the case over in QQQ. And so with the high technology exposure, you would probably say, well, you know what, since we got some high technology exposure, what's probably happening is that QQQ probably has a bigger drawdown than SPY does. And so now, since that we've gone through the holdings of QQQ, let's go ahead and go to the charts, because I love going to the charts, love breaking this thing down and seeing exactly what's going on, because I haven't set any levels on QQQ yet. So now would be a perfect time for us to go into QQQ together, right? Go into QQQ together and set these levels. Look, if you're in the chat right now, please go ahead, make sure you got your computer up, get your trading software together, and let's put these levels in here together, all right? Because like I said, we're here to teach you how to trade for yourself, right? So let's go ahead and share my screen here, because now it's time to go over to Think or Swim. And we look at Think or Swim. This is QQQ, right? This is a QQQ. We look at this chart, 3-year, 1-week chart, right? And we see everything is up and to the right. Everything is up and to the right. So that's exactly what we like to see. This ETF right here has very good performance. Okay, just to put this into perspective, let's just look and see what the performance has looked like over the last 10 years. What has the performance looked like? The performance has been great over the last 10 years, okay? We were at $61.31, the high of $408.71. Now we're at $262.66, but that's still a long way from $61.31, y'all. That's a long way. And, we're coming back down. We're retesting some key levels. We're retesting the key level. Let me go ahead and mark this level. Since we're retesting, I'm going to go ahead and mark this level, 267, 260.11. We're approaching some very key levels, and that really lets you know how bad the stock market has been this year, because we are retesting levels that we haven't seen in 2 years, right? We're like, some stocks are retesting levels that we haven't seen in almost 3 years, right? And so that's important for us to understand when we're looking at these support levels. So I see the support level on the monthly chart that, based on what we get from CPI tomorrow, we might break this level tomorrow. I'm not even going to lie to you. It really, truly depends on what that CPI number is going to look like. And so let's come on down to a smaller time frame. And what I want to do is, the first thing I want to do is, we always want to look at everything from a long-term time span, right? Long-term time span is what we want to look at first when we're charting, because the long time frame provides the trend, right? It provides the trend. It provides the direction to let us know where we're going. Shorter time frames provide us entries, right? Like always remember that long time frames provide the trend. Shorter time frames provide entries. And so first thing I want to draw is, I want to draw our Fibonacci retracement levels, right? Let's go ahead and draw those Fibonacci retracement levels first, because I want to go ahead and get that out the way, and that way we can have something good to look at, right? So remember, we always draw our Fibonacci retracement levels from the 52-week high, from the very, very top of the market, and we want to draw these down to a major low, right? To a major low. And the most recent major low that we have had was during COVID-19. COVID-19 was that area that we had major lows. And so when I look at this, let me go ahead and clean this up. Let me clean this up for a second here. I'm gonna go ahead and clean this up. And what we can see here is that we've got some key levels here. And so remember, a level that I always like to see, a level that I always like to watch is that 50% retracement level. We have broken below the 50% retracement level. And so the next level we're looking at is the 38.2% fib level. That's 257.91. We are very, very close to that level. And we do actually have some support, around that level. So that's the level that we want to kind of watch, because like I said, like we're really digging into support here. Like we're getting into some big support levels. And so just to give ourselves some context, okay, how has QQQ performed? How has QQQ performed over this year? Because we know that we're in a defined downtrend, and as of right now, QQQ is down nearly 36%. Okay, QQQ is down nearly 36% right now from the 52-week high, and so QQQ has been getting beat to sleep. Okay, SPY has been down around 25-26%, so it's been getting beat to sleep as well too. But QQQ has been getting hit even harder, and the reason why QQQ has been getting hit even harder is because of technology, right? Technology being in a high interest rate environment, investors don't want to be involved in tech companies heavily, so they're taking a beating. But at the same time, with QQQ taking a beating, this also presents a very, very good opportunity. And so I'm going to break this chart down to some smaller time frames, just so we can kind of see how trading has been over this year, and kind of really see how trading has been over the last I would say, let's see how trading has been over the last 3 to 6 months, right? That's kind of what I want to see. What has trading been? And so, we've had a series of higher lows, a series of lower lows and lower highs, simply because we're in that defined downtrend. And so right now, we recently had another 52-week low that we made on yesterday, because, we've been getting some bad inflation data. We've been getting some bad economic information. And so that's really weighed heavily on the market. When we look at where we are technically on QQQ, we're almost dipping down into that RSI. Remember that RSI is the relative strength indicator. And so that relative strength indicator measures overbought and oversold levels on stocks. When we're above 70, that means that we're overbought. We're below 30, that means we are oversold, and we dipped below 30 the last week of September. And if I had to put some money on it, right, I would put some money saying that we're probably going to dip below 30 on the RSI sometime this week, if not next week, because we're just so low. Like we're just so low. Everybody is just not liking the fact that the market is bleeding down like it is right now. So we're continuing to have this defined downtrend. And so when we look at QQQ, we look at the chart, and like I said, I've got this 38.2% Fibonacci retracement level set. That's a level that I'm watching as a key level. We could break down below that. I'm thinking we could probably break down below that. And if we go back to the longer time frame, right? Let's go back to the longer time frame and set one more level. Let's set one more level, because I think this is an important level. It's an important level, and I believe it's a psychological level for the market. Now, in February of 2020, this is a previous all-time high. Previous all-time high was $237.47, right? So let me mark that, $237.47. Okay, that's a level that we need to mark, because that's a previous all-time high. Okay, now previous all-time highs matter a lot, because remember support And remember resistance, right? Support and resistance is very, very important for us to keep in mind and for us to pay attention to. Why? Because it tells us certain levels that institutions may get in and may get out of the market. Let me mark this pre-COVID all-time high. Okay, so let me extend this, make sure we get it all the way through. Now, the pre-COVID all-time high, 237.47. Now, if we break below 257.91, I see a slight support level around 251.32. That's what I would see would be our next leg down. But I think that if we break below 257.91 and a lot of economic data comes out and it's bad, I believe we're going to have a date with the pre-COVID all-time high, because the pre-COVID all-time high, that was resistance. So now, since the market is coming back down, that resistance is now turning in and can serve as support. Remember, resistance can turn into support and vice versa, especially when we are reversing and we've had a big defined downtrend. And so these are levels I'm watching. I'm watching the 38.2% Fibonacci retracement. I would say I'm watching level 251.32. That's another level that I'm watching for QQQ, and this pre-COVID all-time high. Those are the levels that I'm watching for QQQ. And like I said, we always talk a lot about SPY. We talk a lot about SPY and what it's doing. QQQ is probably going to outperform SPY due to the fact that it has more technology in it. But with that outperformance, the drawdown is that you're going to have with that drawdown, right? Excuse me, let me break this down. QQQ is going to have more outperformance due to the technology that is in the ETF. But with that outperformance, you have the drawdown. And what that drawdown is, you have a greater drawdown than SPY does, because SPY is a diversified portfolio dealing with all sectors in it. Now, there's something I want to talk about that I want to introduce, okay, into pretty much, I want to introduce this, and I want this to be a tool in our toolbox, okay? And before I even go into this and even explain this, okay, I need to make sure I put this disclaimer out. Please look, I am not a financial advisor, nor am I a fiduciary, okay? Investing comes with considerable risk. Please make sure that you reach out to a financial advisor for help and guidance if you do not know how to invest in the stock market, okay? I'm not an economist. I don't know what the stock market is going to do. So please, do your own research. Don't invest money that you are not willing to lose. And please do your own research, please, before investing into any stock. And so the next stock that I want to talk about, that I believe that it's a good way, in my opinion, for us to introduce some leverage into our portfolio, right? I believe this will be a perfect way for us to introduce some leverage into our portfolio. And what do I mean by that? I mean by the ETF TQQQ, TQQQ. What is TQQQ? TQQQ is a leveraged ETF. It's a leveraged ETF, okay? What does that mean? So you see, I just talked about QQQ. This is TQQQ. And so this is a leveraged ETF for QQQ. And it's a 3 times leveraged ETF. What does that mean? For every dollar that you put into TQQQ, right? For every dollar you put in there, and for every dollar it goes up, you will make 3 times on your money, right? You will make 3 times the amount on this money, right? For every dollar that you put in. But it also works in the reverse. For every dollar that you put in and the market goes in the reverse, right? When the market goes in the reverse, okay, what's going to happen? What's going to happen is that you're going to lose 3 times the amount, okay, as your dollar value goes down. Now, this is an ETF. These are not options. So when you buy TQQQ, it's not going to expire on you. right? It's not going to expire. This is a leveraged ETF. It's introducing leverage, and this is very, very risky. That's why I had to put that disclaimer out there, because I want you guys to be careful. But this is potentially a good opportunity for us, because I think you should buy TQQQ in a bear market, right? Like, look at where we are technically over the last few years with TQQQ. And I'm going to break this down. I'm going to look at this over a weekly. I'm going to look at a weekly chart over the last 5 years, so we can really truly mark off some levels on this stock. Now, like I said, this is a leveraged ETF. Look at the all-time high, 91.68%. And I really want to put some things into perspective right here, because I need to do this. Okay, I need to do this. Let me draw this trend line. Where we are right now, TQQQ is down 80%. Okay, this stock is down 80%. Like I just told you, QQQ was only down 30, 35 at max. This is down 80%. So when QQQ is getting beat to sleep, man, you are going to be getting beat to sleep. But this is the thing. Like I said, this is the thing. And so, we've had that situation that has been going on with this ETF. But let's measure the performance from COVID. And to be completely honest with you, we're approaching the COVID bottom. Like let's just be honest here. We're approaching where we were in COVID. We're about to have a multi-year double bottom on this ETF. But let's look at the trend line. Let's look at the trend line, and let's measure what was the performance from the bottom, because I'm curious. I want to see what was the performance from the bottom when you look at TQQQ. I'm sorry for laughing, y'all, but this is insane. This is insane, y'all. This stock went up over 1,000%. Okay. From the bottom, from QQQ, when we were in the depths of COVID-19, y'all, this stock was up over 1,000%. Okay. Am I telling you that QQQ is going to go up 1,000% for you? That's not what I'm telling you, right? That's why I said disclaimer. I'm not saying that. I didn't say that QQQ is going to go up 1,000% for you. But what I am saying is that I believe that we are a lot closer to the bottom than we are to the top. And if you're going to buy a leveraged ETF, you want to buy a leveraged ETF in the depths of the bear market, and you can build a position and average into it, because this TQQQ, think of it, it's really a derivative of QQQ. It's just not exactly an options contract. You see what I'm saying? So this is really this is leverage. Don't get me wrong. You can lose a lot of money here, but technically it's safer than an options contract, because with options, the contracts can expire. No matter if you're buying leaps, no matter if you day trade, no matter if you swing trade, no matter whatever you are doing, you have more risk than you have by buying this ETF. Now, since we've been going over this, let's just go ahead and mark some levels, shall we? Let's go ahead and mark some levels, because this is important for us to understand, because like I said, this is a good opportunity, I feel, that we can use to introduce leverage into our portfolios. Now, like I said, investing comes with considerable risk. Please seek out financial help. Do not invest more money than what you can lose, right? Please. But understand this, because I'm telling you, if you think that you've been getting beat to sleep by buying AMD or buying Tesla or buying Apple or buying Microsoft, you buy some stuff like this, you really gonna be feeling bad. You're really gonna be feeling bad about what's going on, right? Let me go ahead and get these Fibonacci levels set, because I really want to break this down, because me personally, I really think that this could be an opportunity for us over a 2-year time span, because we have to ask ourselves the question, and this is just what's very, very important. We just have to be honest with ourselves and just ask the question, where do we think the market is going to be 2 years from now, 24 months from now, like let's not even worry about 2023, because if the Fed does continue to raise interest rates into 2023, it's probably going to be a problem for us in the stock market, and the returns are going to be lower than what we are expecting. But ask yourself, like really ask yourself, what is the stock market going to be like in 2024? Where are we going to be in 2025? Where are we going to be in 2026? Just ask yourself that question. Ask yourself, okay, what is the macroeconomic looking like, right? You're positioning yourself. I'm not telling you to sell all of your stocks and put all of your money in the QQQ, leverage up and go up 1,000%. That's not what I'm saying. Take a portion of your portfolio and put it towards leverage when you have opportunities, when it presents opportunities, right? We don't just go out here all willy-nilly and just going crazy. That's not what I'm telling you to do. But what I am telling you is these percentages are not lying to you. Like numbers don't lie. Numbers don't lie. Men lie, women lie, numbers don't. Okay, like men lie, women lie, numbers don't. These numbers and these percentages, I'm talking, these are real. This stock went up 1,000% in 2 years. This stock came down 80%. Like this is real. And so since we're talking about that, let's just look at the Fibonacci retracement levels. Remember, we always drop from the top to the bottom. We know that. We've broken this 23.6% level. And so typically what I've seen when I've seen people talk about Fibonacci retracement levels, when you see a stock break this 23.6% level, it means the stock is broken. And what that means is that you don't want to be trading this stock necessarily, as far as like, oh, I'm going to get into it today. I'm going to get into it today and get out of it tomorrow. Like, no, like you want to build a position. And so, like I said, I think it's a fairly good idea, y'all, for us to start building a position here. Like, I really think it's a fairly good idea for us to start building a position, because what I'm going to do is I'm going to look at where was QQQ in 2018 all the way to 2020. Let's just look at where TQQQ was at from 2018 all the way to 2020. Okay. And what I want to do is we look here, we got some resistance over here. We got some resistance over here in December. We had some resistance again, and then we broke out, right? Resistance, and then we broke out. So let's go ahead and mark a level. Let's go ahead and mark a level, and let's mark this level around. Let's go ahead and break the difference, because we got $16.99 here. We've got $17.16 here. We've got $18.29 here. We've got $18.34 here. Let's just put it at $17.50. Let's just mark $17.50, right? Let's just mark $17.50. That way we can be, let's mark $17.25. Okay, let's go $17.25, excuse me, as resistance. Okay, let's mark that as resistance. Now, what's important for us to understand is that TQQQ closed at $18.10 today. That's where it was. So we're coming up on resistance from 2019 and 2018. That's where we are on this particular stock. Put that into perspective. This is the time where you want to start building a position. Look, tomorrow we're going to have CPI. We're going to have consumer price index, and everybody is expecting the consumer price index to be just blow out the water, right? To really truly be bad. If the consumer price index is as bad as what everybody else is expecting, the S&P 500, the Nasdaq, the Dow Jones, the Russell 2000, bond yields, everything is going to be down. So we'll probably break this $17.25. We'll probably break it. We may come down here, touch it, but then break below. Look, I'm not a financial advisor, y'all, but if we break below that 17.25, I think we should start building a position below that 17.25, y'all, because we've got some support here at $13.75, supporting 2018, supporting 2019, right? We got some more support around here around $11. So we can just keep marking levels. We can just keep marking levels all the way down. And then we've got the bottom. We've got a COVID bottom. Remember, we had a double bottom again. So we can come back down and retest this again. Y'all, this is a strong level. This $7.58, this is a strong level here, y'all. Like, this is really, truly a strong level. And so that's really an area that's really an area where I'm looking at this situation and I'm saying, yo, I need to put some money to work here. And so let's just go back out to the top and let's just look at the long-term view of this particular stock. Like I said, y'all, in review, let's just review this thing, right? Let's just review this thing. Remember, what is this stock that I'm looking at for the people that are just coming into the chat? What am I looking at right now? We are looking at TQQQ. This is a leveraged ETF, meaning that this is technically a derivative of QQQ. This is a 3x, a 3x leveraged ETF, meaning that for every dollar that you put into this ETF and for every dollar that it goes up, you will be making 3 times on the amount of money that you put into this ETF. But it also works on the opposite side. Okay, it also works on the opposite side. For every dollar that this thing goes down, you're gonna be losing $3. And so that's why I gave my big disclaimers and just kept repeating them over and over and over again. But look, this is what I'm telling you. Like I said, I'm not a financial advisor. This is something that I am going to be introducing into my portfolio. Okay, I'm going to be introducing some of TQQQ into my portfolio at these, lack of a better term, atrocious levels. Atrocious levels right here is when I want to buy. Do you want to be, look, put it like this. Do you want to buy QQQ at 91 or at all-time highs? No. You do not buy QQQ at all-time highs. To be honest, I wouldn't even recommend you buying QQQ in a normal bull market in general, because it's just so much risk and you can't really time it. Because if we were in a very, so for example, let's say we were in a normal market. Let's say we were in a bull market. If we were in a bull market, I would rather you just buy QQQ. Just buy QQQ because we're in a bull market. That's what we want to do. The thing is, though, is that when you have price dislocations and when you have the market down so much, when the market comes down so much, what you have to do as an investor is to go through the market and find opportunities for you to have great returns over a 24-month time span. Remember what I said. This ETF right here is QQQ. It's pretty much just moves 3 times as much QQQ. So pretty much this is QQQ just on steroids. That's all it is. It's just QQQ on steroids. And that's a good way to put it. I'm glad. Thank you, Devon. Thank you for saying that. TQQQ is just QQQ on steroids. And that's what we're looking at. You know, like I said, this shouldn't be all of your portfolio. I'm presenting this as a leverage opportunity for you. Please do your own research and make your own decisions before getting into this ETF. Now, the one last thing I want to talk about before is the moment that we are waiting on tomorrow. Tomorrow is the moment that we are going to be waiting on. And the moment that we're going to be waiting on tomorrow is, what is that CPI number going to be? Okay, that CPI number is going to be very, very important for us tomorrow. Also, not to mention that we are getting earnings reports from Taiwan Semiconductor. We're getting earnings reports from BlackRock. We're getting earnings reports from Delta Airlines. We're getting earnings reports from Domino's Pizza. Friday, we're getting earnings reports from JP Morgan. We're getting earnings reports from Morgan Stanley. We're getting earnings reports from Citibank. We're getting a lot of earnings reports. And so what we have to understand is that if this inflation number that we get tomorrow is bad, the Fed is going to keep these higher rates to stay in place, and they're going to stay in place for longer. And so today what happened was that we received some Fed minutes. We received the FOMC minutes. So the FOMC stands for the Federal Open Market Committee, and they had a meeting last month, and they were talking about the plans that they have to continue tightening despite the slowing labor market. Okay, this is not good for the stock market at all. That's really truly why we have to be careful, and we have to be nimble and have certain prices that we're getting in and out of the market. And so Federal Reserve officials have been surprised at the pace of inflation and indicate at their last meeting that they expect higher interest rates to remain in place until prices come down, according to minutes released Wednesday from the central bank's September meeting. In discussions leading up to a 0.75 percentage point rate hike, policymakers noted that inflation is especially taking its toll on lower income Americans. They reiterated rate hikes are likely to continue and higher rates will prevail until the problem is showing signs of resolving. Participants judged that the committee needed to move, and they need to maintain a more restrictive policy stance in order to meet the committee's legislative mandate to promote maximum employment and price stability, the meeting summary stated. Now, put this into perspective, okay? Officials further noted that with inflation showing little signs so far of abating, they had raised their assessment of the path of the federal funds rate that would be likely needed to achieve the committee's goals. So they're thinking about raising interest rates even higher than what they had previously anticipated. The S&P 500 gained slightly on Wednesday after the release of the minutes, as some traders took one comment as a signal the Fed could back off its rapid tightening if there was more financial market turbulence. Now, what did they say? Several market participants noted that, particularly in the current highly uncertain global economic and financial environment, it would be important to calibrate the pace of further policy tightening with the aim of mitigating the risk of significant adverse effects on the economic outlook, the minute said. So pretty much what this means is that if the United States of America goes into a deep recession and we end up having a deep global recession, then the Fed is pretty much going to make some changes, right? They're not going to keep having that vice grip on the market like that. Okay. They're gonna let up a little bit. They're gonna let up off of the gas. But if this inflation and if the labor market still keeps showing good job numbers, they're not going to have any reason to let that vice grip up off of there. They're going to be like a python, just squeezing and squeezing and squeezing like a lemon and an orange, like just going to keep on squeezing. Now, the meeting happened ahead of a recent flow of data showing that inflation pressures do remain elevated, though not at the pace they were earlier this year. The Fed's preferred inflation gauge of consumer price expenditures rose 6.2% from a year ago, negative 4.9%. Well, not negative, but 4.9% excluding food and energy in August, according to data last month that was well above the central bank's 2% target. A report Wednesday showed producer price index rose 0.4% in September. Participants observed that inflation remained unacceptably high and well above the committee's longer run goal of 2%, the minute said. Participants commented that recent inflation data generally had come in above expectations and that correspondingly, inflation was declining more slowly than they had previously been anticipating. That's what they were saying all last year. All last year, they were saying that inflation was just transitory, meaning that it was just temporary. When we really found out, it really wasn't temporary. Now, members of the rate-setting Federal Open Market Committee noted at the meeting that the economy needs to slow to get inflation to cool. They lowered their projection for the economy, expecting GDP to grow only at 0.2% annualized pace in 2022 and just 1.2% in 2023, well below trend and big drop from 2021, which saw the strongest gain since 1984. And we've got to put that 2021 year into perspective. We kind of got to put it into a box, because the economy was just it was a lot going on. People were getting a lot of money. Okay, people were getting a lot of money. Now, long-term inflation outlook, they said inflation was being driven by supply chain problems that were not limited to goods, but also to a shortage of labor. However, officials also expressed optimism that policy would help loosen the labor market and bring down prices. Officials have said lately they don't expect rates to stay high until inflation comes all the way down to 2%. Participants judge that inflation pressures would gradually recede in coming years, right? The summary said. The meeting concluded with the FOMC approving its third consecutive 0.75 percentage rate point increase, taking benchmark rates to a range of 3% and 3.25%. Markets widely expect a similar size rise to be approved at the next meeting in early November. I agree with that because there's not going to be any additional information that's going to get them to back off. Officials did note that they see a point coming when the pace of rate hikes at least will decelerate, although they did not put a time frame on when that will happen. Of course, they're not going to do that. The minute said that FOMC members noted it would become appropriate at some point to slow the pace of policy rate increases while assessing the effects of cumulative policy adjustments on economic activity and inflation. They said that time would come after the Fed funds rate had reached a sufficiently restrictive level, after which it likely would be appropriate to maintain that level for some time until there was compelling evidence that inflation was on course to return to the 2% objective. The summary of economic projections at the meeting pointed to a terminal rate or endpoint of rate increases to be around 4.6%. Markets expect the Fed to hike into early 2023, then keep rates there through the year. Right now, understand this. Understand that there's going to have to be significant data that's going to have to come through to get the Fed to slow on their interest rate hikes. Okay, we're going to have to see unemployment go higher. Okay, we're going to have to see unemployment go higher. We're going to have to see job openings to go down. We're going to have to see real wage increases month over month to come down. We're going to have to see housing prices to come down. We're going to have to see, more metrics like broad range metrics in the economy to come down. We're going to have to start seeing weakness in the economy. Like we're going to have to start seeing companies not performing very well, like broad range S&P 500 companies not reporting good revenue and not reporting good profit in order for this inflation to come down. And so I'm not sitting up here telling you that I know exactly where the Fed is going to go in terms of the Fed funds rate or if inflation is going to come down. I have no idea. I've been wrong about inflation all year. I thought by this time we would have finally been able to rake it in, to reel it in. We're still at over an 8 handle in a year-over-year CPI inflation. If we get the 7%, like let's say we do have 7% tomorrow. Let's say we get 7% tomorrow, the market rallies. That might be okay, but I'm just not gonna put any money on it. I'm not putting any money on it. So that's some things that we just need to pay attention to, and we just need to pay attention to them very, very closely, in this bear market. And so as we wrap up, y'all, I appreciate y'all again, as always, for coming back to another episode of the Trade for Yourself podcast. Again, please make sure you like this. Please make sure you subscribe. Okay. Like, I introduced something to you, some leverage to your portfolio that you might be able to use. I told you to be very, very careful. I told you to be extremely, extremely careful. Just because I'm probably going to be putting a portion of my portfolio in TQQQ, I'm not telling you to do it. That's not what I'm telling you to do. But what I am telling you is that you should buy leverage. You should buy bullish ETFs that are levered 3 times when we're in a deep, deep bear market, because you really just have to sit down and ask yourself the question, where do you really think the stock market is going to be 24 months from now? Where is the stock market going to be 36 months from now? Where is the stock market going to be 48, 60, 72, 84? Where's the 96 months, 108? Where's the stock market going to be over long periods of time? And this is a good way for you to add some diversification to your portfolio and for you to add some leverage and for you to get some outsized returns over time. As always, appreciate y'all as always again. Remember, don't pay for it. Trade for it. I'm going to catch up with y'all again next time. Remember, buy and hold. Buy into weakness, sell into strength. Let's go build wealth, y'all.